Hi, ABD. I'm Meredith Heyman. This is Industry Insights. Thanks so much for joining me. The energy sector is once again heating up. That's in part due to the spike in oil prices as conflict in the Middle East continues. But will the energy rally persist? And how does geopolitical unrest influence the market? Joining me to discuss is Barron's market reporter, Jacob Sonenshine. Jacob, thanks so much for being here.
Thanks for having me.
Absolutely. So currently, what's going on in the energy sector?
Well, you've got oil up by a double-digit percentage in a period of months. Not uncommon for oil, but WTI crude is over $80 a barrel. The most recent development that everybody is aware of, obviously, is the conflict between Israel and Iran. Fortunately, Iran was unsuccessful in its attack because of the Iron Dome, but clearly there are tensions. So anybody involved in markets is concerned about the supply of oil and the price going up. The price of oil since this happened hasn't gone up that much, maybe for like a brief moment. But one of the big underpinnings, while you have little concern about supply, is that you have global economic demand has just continued to be way better than expected. And that's good for the price of oil. So that's how you get a price of oil right now above 80.
Tell me more. How is the conflict in the Middle East influencing oil and gas related stocks?
You've seen in little moments here and there, these little spikes intraday trading in oil futures. But the price of WTI crude oil is unable to get above the mid to high 80s area. Oftentimes in the last few years, except for Russia, Ukraine, when oil went to above 100, oil couldn't get above the mid to high 80s. And I think one of the issues that the market is well aware of, we saw this when oil went above 100 and came right back down to the 60s. The market is aware of something that I love. This one strategist from Evercore always talks about. The cure for higher oil prices is higher oil prices. So what that means is that price goes up, the risk of broader inflation in energy and in other goods and services goes up. Interest rates remain up because nobody thinks that the Federal Reserve at this point is going to cut rates. You have oil up and inflation up. What does that mean? This all hurts economic demand. And ultimately, the market is aware that this would hurt demand for oil. That's why oil goes up and then it comes back down. This is part of a picture where the stock market is about 4% below its all-time high, S&P 500, because people are concerned about inflation rates and the economy.
Bigger picture, when there's geopolitical risk, how do investors typically react?
Well, when there is a low probability that geopolitical risk will rear its ugly head, you call that risk, which again is low probability, you call that tail risk. It means that markets are unlikely to have this huge and ugly move oftentimes. But what happens is that risk flares up. You have a conflict in Israel and Iran. You also have a conflict in Russia with Ukraine. That's well understood by the market. You have tensions in Asia between China and Taiwan. You actually have multiple tension points geopolitically that the market is starting to become aware that they're low probability events in terms of horrible warring flare-ups and a spiking price of oil. But the market is aware that the risk is growing just a little bit right now. There are some rumblings across the globe. And so what's going to happen is if any of these risks comes to fruition in full, there's a horrible war or something really awful happens, the price of oil spikes, and really it creates broader inflation for companies that have to buy oil and lift their prices. And then the Fed can't just start cutting interest rates. And then the whole financial market is kind of up in arms.
And oil prices and the performance of the energy sector, how does that influence the economy and then inflation?
If you were to think that crude oil prices will spike and sustain that spike, you're going to have a lot of buyers of crude oil, like airlines. That's just one, but there are tons of companies out there that produce things, that make things, that need to buy some sort of oil or crude substance. And they will be incentivized to protect their profit margins to lift selling prices. And that's how you get inflation. That's how you get higher oil bleeding into broader inflation throughout the economy. And that's how you get this scenario where, the Fed can't cut rates. Look, right now, nobody really thinks the Fed really wants to cut rates at this point. But if you were to get this spike in oil from these geopolitical issues, you get even more inflation, and there's no chance you get a rate cut. Maybe you'd even get another rate hike. And we know that the stock market and the economy does not want that.
And how does the commodity market influence the stock market?
There are many periods of time where rising commodity prices, copper, oil, is consistent with strong economic demand, growing earnings for companies, and a rising stock market. The problem right now is that the S&P 500, since that COVID bottom in March 2020, is up tons, right? So we had this bear market in 2022, but we've recovered that. We're up tons and tons in terms of really global stocks and the S&P 500, reflecting what has been an incredibly hot economy the last few years and what has been great earnings growth for companies the last few years. Now the stock market has totally reflected that in the price of stocks. So what does that mean? Now it means that if commodities go up and if rates go up, it's going to take the steam out of the economy, and the market gets ahead of that. The stock market says we can see that happening, and stock prices go down because we reflected the economic strength. Now there's a lot of economic weakness that remains a threat because of inflation and rates.
What do investors need to know when it comes to these two markets right now?
If you want to buy stocks that right now are the most vulnerable to a decline, small cap stocks, economically sensitive stocks, like some industrials and many banks and retail, consumer discretionary, restaurants, let them drop a little bit. I think they need to come down a little bit. They have been, but they may come down even more. And then you can go buy, because I don't really think we're going to have a recession. The market's trying to price in maybe slower economic growth, maybe. But those cyclical and small cap stocks, wait for them to come down a little bit, and then you can buy. If you don't want to time the market, which is kind of hard to do sometimes, there is a great group of stocks. They're called dividend growth stocks. They're very low volatility. They're in defensive sectors that aren't that economically sensitive. Find the ones, I just did a piece on it in the month of April. You'll find it under my byline on dividend growers. Find the ones that have consistently grown their dividends. They don't need to grow earnings that much. They're cash cows. Their balance sheets get bigger and bigger every few years. They can keep paying you higher and higher dividends. Those are great yields without a lot of volatility, and that's a good deal for investors that don't want to time the market.
Absolutely. All right, Jacob, we'll be watching. Thanks so much for joining me. This is Industry Insights. I'm Meredith Heyman. Thanks for watching IBD. We'll see you next time.